Every trader believes that their $500 stop loss is being hunted by hedge funds. They believe that some institution woke up with the wrong foot just to stop that trader out. But here's the surprising part. The market does indeed target your stop loss. Now why is that? Because 99% of traders are putting their stop losses above and below the same levels. They're just going to call it differently. ICT, SMC, support and resistance, indicators, whatever it's going to be, it doesn't matter. But they all lose because of one fundamental reason. By the end of this video, you'll know exactly where to put your stop loss. No more second guessing of, okay, is it going to be that high or that low? I'll show you the exact blueprint of where I'm putting my stop loss every single time. So you're not going to be ending up extra liquidity, but actually know how to trade like the banks. Now, the very first step in understanding how the stop loss are going to get hunted, we need to understand the phase and also the range that we're currently in. The market is always in a phase and a range at the same time. Your job as a trader is going to be to identify where is that range and what phase are we in right now. Now the phase determines your direction for the current day, whether it's going to be a long or is it going to be a short. The range, on the other hand, is going to determine how and where you're going to be entering a trade. Now both of these things need to work together, because if not, then they're not going to be working. So let's concentrate on identifying the phase that we're currently in right now. The most common mistake that I see traders do is doing something like this. We are currently on the 50-minute time frame, as you can see. They're looking at price like this, and then they're saying, well, you know, we have a high in here, but we also have a low in here, and then we have that. You're looking at too much information. You need to zoom in into the short so you have a clear framework. See it like this. When you're telling AI to generate a picture for you, and you didn't specify what kind of picture you want, then it basically has infinite amount of options that it's going to generate a picture off from. But if you're going to tell it, generate me a picture exactly of a high and a low and XYZ, then it's going to basically limit all of the different possibilities that it can generate you. Do you get my point? This is basically the same that we have in trading right now. When you're looking at all of this, that creates room for failure. That creates room for just making more and more errors. But when we're looking for something very internal and having a very defined range of what we're looking for, well, then it's already a different story, because now we have a framework to build out from. Now, currently, what is the phase going to be to begin with? Okay, now zooming out a little bit is fine, but anything like that is already way too much. Clearly, you can see we are going higher. Okay, we're making higher highs and we're making higher lows, so that's an uptrend. Also, recently we have seen that we have a little bit of a decline. Now we had our regular FEGs. These are just all imbalances that we like to trade into. So we now want to ask ourselves, are we just going to continue on to the upside and basically all of this is just a pullback, or is now the real move to go on to the downside? For that, you don't even want to zoom in or out, but you just want to basically look at a higher time frame. As you can see, for the long term, on the 4-hour time frame, you're going to have two swing highs relatively equal close to each other. So that means that the price is going to get higher. So that actually does not speak for our entire direction, because if we're going to look at it on the 50-minute time frame, we are clearly just trading lower, right? And this is basically all that I want you to pay attention to. The reason why I'm still marking this out on the 4-hour time frame, this entire liquidity point, is because you need to understand the higher time frame bias. We are also going to get into that in just a bit. Now, this is going to be the phase. How do we identify the range? The range is by far even more important than the phase. They work hand in hand, keep that in mind, but the range is a little bit more with nuances attached to it. So our range is going to be always internally. Once again, that's why I've told it to you, don't do something like this. That is already external, okay? Don't do something like this. It has to be very recently, okay? The most extreme high that I can see over the past couple of candles is going to be that high. The low in that case is going to be that one. Most extreme high, most extreme low. So you see, we are having an entire range already. So anything that happens in here, we want to participate in. There's going to be also more advanced examples where you can trade outside of the range and then either continue your movement higher. That's why I've also shown you the higher time frame liquidity point, remember? Or you're just going to basically reverse the trade from here after you have traded into one of those extreme points. And then from there on, you're going to trade into the other extreme point. All of this has to happen at 8:30. If it's not going to be at 8:30, then don't expect this to work. From this point on, we basically just want to identify, okay, we have a swing high, we have a swing low. Where do we want to go? Now, and here's what's so important about all of this. If you're having this high and you're having this low, what does that create basically? Yes, a range, we all get that. But that now creates a 50-50 scenario. So already you're limiting your options, okay? That's what I want you to take out from this entire video as a whole. You want to shrink the entire possibilities that your trade can go into. You don't want to have a million different reasons on why the trade should go higher or lower. So we are already limiting ourselves by having a 50-50. Either we're going to go for the high or for the low today. You know, either of those is going to be fine by us. So this already creates less options and less room for error, because it also means that you could potentially just flip a coin and you're 50% going to be right off, because you could even just flip a coin and 50% of the times you're going to be right. But of course, due to confluences, there is reasons on why we need to trade into a certain direction. This is what we're going to talk about now, because of course, having the range is only half of the story. Where do we actually trade? What's the higher probability here? You're going to look at it this way. Which high has basically more magnets attached to it? Is it going to be the low or is it going to be the high? What are magnets to begin with? Magnets are going to be liquidity points. Those are going to be FEGs, imbalances as a whole, order blocks, anything, you name it, okay? Anything that holds liquidity behind it. The idea of liquidity is basically that stop losses reside below certain highs and lows. Now, the whole idea of liquidity is that every single swing high and every single swing low that you see holds liquidity, every single one. Now, but not every single one holds the same amount. Some of these lows and highs hold more value, so they're more targeted by the market maker in that sense. So we want to ask ourselves, okay, is this high going to hold more liquidity than this low? And for that, to basically identify the magnets, you need to see what has recently happened. So in that case, I am only pretty much seeing that high and nothing else. I don't see another high that is very close by. I don't see an FEG. I don't see anything else like that. But for the lower side, it's a different story, because we can see we have a very close by low that is very close to this one. So these create basically relative equal lows. So this is already our magnet, okay? And you're basically going to be weighting it out like this. Let me show it to you real quick. So basically, the left side is going to represent the high and the right side is going to represent all of the lows. We're going to put it like this. Well, we have basically one reason, and that is not even a reason, that is just a high to trade higher. But we have one, so basically the low in itself, and also another one. So logically, where are we really going to go? Lower or higher? Of course, my friend, it's going to be lower. From this point on, we're basically just want to look out for more confirmation. Now that we have identified the magnets, a clear direction, the bias basically, now we can actually take on and continue trading in that sense. Now, and it's also always worth it to go on a different time frame and look out for more confluences. On the 1 hour time frame, once again, I'm also now doing something like this. Very, very nearby. Something that has recently happened. What we can spot in this entire price action is going to be that we have an FEG in here. FEGs like to get traded back into. It's an imbalance after all. So we're already creating that low, so basically the relative equal lows, and also that FEG. Right now, we are already having two different confirmation points. In this like scale thing, I just marked out the low. So we already have basically three different things why the price should go lower in that sense. So from this point on, we pretty much have all of the confirmation that we need in order to trade lower. And this step is so important. Most of guys have already skipped basically this part of the video. You need to basically combine different time frames in order to get a clear bias. I know it is very easy to just say, okay, I don't want to do all of that. 50-minute time frame is all that I need. Yes, that is indeed all that you need. But if you want to maximize the profits, then you need to have a higher time frame point of interest that you're looking out for. So in that case, we're having this entire 1 hour FEG that we have marked out, but on the 4 hour time frame, it's a similar story, but not the same one. We're having a 4 hour FEG. So that already creates even more confluences why we want to trade lower. Now we are not just looking at a one-time event where we are just having a 1 hour FEG in that sense. But now we are stacking on top of each other multiple imbalances, because 2 FEGs is better than 1 FEG. But the same doesn't work for condoms. From this point on, let's go on to the 50-minute time frame and ask ourselves once again, what's more likely where we're going to trade it towards? Of course, it's going to be the low. From this point on, I would like you to remind basically that you can take this in any sort of direction that you want. You're always going to be having confluences that are speaking against your trade idea. This can be anything, and we'll also see this in examples later on in this video. So let's just say we had relative equal highs in here and also an FEG. So then your job becomes basically you have to weight the confluences. The thing that I've done previously, where I've put 1 to the left and then 2 to the right. You have to basically think which one has more weight behind it. Okay, without further ado, let's go on to the 1 minute time frame. So our entire objective is to trade lower. Now, but the problem is, if you're just blatantly going to be taking a short, then a lot of the times you're just going to be taken out basically, even though you were right on the direction. You knew where we are going to go in that sense. Okay, from this point on, we are on the 1 minute time frame. If you just understand where price will go, but you're not able to enter, well then of course there's going to be no trade. So from this point on, we are looking for something very specific. First of all, we have basically seen that we have traded onto the downside, and that is a good sign. Ideally, what you would like to see is a fractal shift, basically taking out liquidity, and then you're going to be trading lower. This is basically the entire pattern that I like to trade every single day in a nutshell. But to get it more specifically, what do you do in these kinds of situations where you're just going to trade lower? Because I could have just picked a cherry pick setup where it's just very obvious that we're going to be trading lower, and then from there on I'm just going to be taking a trade, have a fractal shift and lower. But I'm going to be honest with you, if you just understand these examples where it's just, you know, written out of a book, then you're not going to be able to do this yourself. So from this point on, what do? Okay, basically all of the things that we wanted to do already happened, and we don't have a trade entry. No. So since we are, this is why I have gone on to the 4 hour time frame previously, and I've also identified these highs. The higher bias screams onto the upside and not to the downside. So that also means that perhaps we are going to be finding an entry higher and not lower. From this point on, we want to skip the candles. So we are hovering around within this entire FEG. We have left a big imbalance onto the 1 minute time frame. Keep in mind that doesn't matter too much because we've also already traded into it, but it's good to keep in mind. And from this point on, we basically just want to skip a couple of more candles. Now, what do I want to see? Our fractal shift in that matter, we are going to be waiting out for a little bit longer. Okay, we need a big candle like this one. But our liquidity rate we already had. We've taken out liquidity. From this point on, there's a good chance, okay, we could be reversing. But we need confirmation once again. See, if we would have taken the trade just because we had 2 bullish candles, this would have been a loss already. So you need to see fractal movement, a shift within a shift basically. You see, this candle is already telling you the truth basically. And you have to compare it. I have a lot of examples prepared, and you will see why. Because this candle is big, but it is only big because I'm able to compare it to this one, I'm able to compare it to this one, I'm able to compare it to this one, and to everything that has previously happened. Okay, now if the candle, let's just say that every single candle is looking something like this, and we want to trade lower, okay, and then some other candle is looking like this. Well, yes, that candle, that bearish one, is bigger than this one, and this one, but comparable, it's not really that much bigger. Okay, but here you clearly see that's pretty much the biggest bullish candle that we had within the last 50 candles or so. That's why it matters. That is the easiest way when you're going to be identifying and basically asking yourself, well, StarTrading said that we need a big candle, but at what point is it going to be a big candle? There you go, you need to compare it. Now, for the stop loss, you're basically going to be having 2 options. In that case, we have already been taking out our 15-minute low basically. It was previously this one. Let's just mark out this one. You're either going to be putting your stop loss below in here, but in that case, we have already traded lower of our entire range. So what do we do now? What I personally just like to do is put my entire stop loss below the last liquidity rate that has occurred. It's going to be this one in this case. And then I like to aim for a take profit, something that is internally. And if I can't find something internally, then I'm just going to put the entire take profit all the way for 142. Or if I see starting to see some weakness within price. So let's just say we had strong aggressive move higher, then we have these liquidity points trading lower. From this point on, I would expect price to trade higher again, but it just continues and hovers around. Then I'm just going to close the trade whenever I see a little bit of consolidation going on. But this is a little bit more of a niche example. Most trades, they will simply just run into a take profit, to be honest. So from this point on, I'm basically waiting. I've taken a trade and I'm patiently waiting until I can set my stop loss to break even. Now, break even confirmation is another point on its own. You always need to have clear defined rules of when you're going to put your stop loss at break even. Because if you don't have that, then you're just going to be trading and doing it based off emotions. And if you're going to be doing it based off emotions, then let's just say the trade isn't here. You're putting your stop loss at break even though there's no logical level attached to it. You get out and then it runs into your take profit. That's the worst case ever. Okay, that's the worst feeling ever when you got taken out at a break even, when in reality you shouldn't be taking a break even trade here and it ran into a loss. into a win. And it ran into a win. Of course, break even is better than a loss, but you also don't want to be missing out on the trades. From this point on, we're just going to be skipping the candles. Now, what is going to be the confirmation that we want to set our stop loss to break even? It is going to be right now. It's not going to be because we just had strong movement. That is an indication. But it's more so because we have taken out something internally. Now notice, the more internal you go, the more complicated it gets. If you're just going to have this entire rabbit hole and you're just going to basically go deeper and deeper and deeper into the internal, then you're basically going to get nowhere. So there has to be like a fine line of what is going to be too much into the price action, what is too internal. And it is basically the same principle that I've shown you on the 15-minute time frame. As you can see, we have the most extreme low, the most extreme high. That is pretty much all just internal. Okay, I'm not looking at something that has happened previously. It has to be very specifically what has recently happened. Okay, so once this high has been taken out, I'm putting my stop loss at break even. It's not going to be this high. It's not going to be this high. It's not going to be something else that is going to occur in your trading examples or when you're trading this. No, it has to be this high. Okay, from this point on, we're just going to be setting our entire stop loss to break even, and we're just going to let it run. Now, trade management as a whole is also important because let's just say that we don't have a high. This is also an example that I want to teach you about. Sometimes you're not going to be having a high like this, something that has internally happened. What I just tend to do, what is a good rule of thumb, is going to be once a trade has run like 1-to-1 into a take profit, that's when you're just going to put it at a break even. Okay, this is just what worked the best for me so far, but you ideally just want to see if the price starts to consolidate. That's usually a bad sign. You want to see strong movement until your take profit has been hit or your loss has been hit. From this point on, we're just going to be skipping the trade, and basically we have broken another internal high. Now this is going to be very important. We have created an FEG in here, and the reason why it's so important is because once you have movement into one direction, you can expect to have a pullback sooner or later. We're basically taking advantage of an external downtrend. But this, all of what we're doing right now is just a pullback that we're trying to trade higher. But the same goes for what we have right now. When we're trading higher, there's a good chance that we're just going to trade lower. Now you see, in that case, our break-even point is able to endure that entire FEG. But for the purposes, I like to also even set my stop loss to some kind of low that is below the FEG that I'm trying to trade towards to. Does that make sense to you? Because a lot of the times when you're going to set your stop loss right in here, so at break even or below that FEG, that is going to work out fine a lot of the times. But sometimes the price likes to basically hover around even more. Okay, you're going to have something like this where the price is basically trading towards your target, and it's not immediately reversing, but it's hovering around, retouching it, retesting it multiple times, even goes below it, and only then it's going to trade higher. Because keep in mind, the market is not perfect in that sense. So from this point on, we are marking it out. Stop loss, we're going to either basically risk it and put it at a break even, or we're going to play it more safe. A lot of you guys would say, no, safe is playing break even. No, safe is playing it in here because you don't want to miss out on the trade. So from this point on, we're going to be skipping the candles. This is not even a scenario that has to occur in this entire price action. This is just a general thing. Okay, this is what I look out for when I'm taking these kinds of trades. And from this point on, what have I previously told you? If you start seeing weakness of the entire price action, then that on its own is not a bad thing. You can't just go into one direction forever. There's going to be consolidating phases and also pullbacks. Now, but the question is, would you like to risk it and basically stay into the trade, or are you just going to be happy with your 1-for-1 and get out of the trade? Because this is what kills most traders. Okay, I don't need to trade a 1-for-10 or something like that. I focus on rather having a high win rate. So unless you really want to risk it, you can basically do that, but I don't recommend that at all. So we rather want to get out at our 1-for-1, and that's it. This way you're going to ensure that you're going to be such a high win rate to begin with. Okay, the whole premise of this video is that your stop loss is not going to get hit. The worst case, the worst thing that it happens is if your stop loss gets hit. I've previously also emphasized that you don't want to have a break-even trade like that. You want to give the trade room. But of course, if you have to decide whether or not take a 1-for-1 trade or take a break-even or a loss, then I mean the ranking is pretty clear, okay? And this is going to depend a lot on emotions. Let me show you an example which is a little bit easier. This was one of the harder examples that I've actually shown you right now. So if you expected a 1-for-100 RR trade, then you're at the wrong place. I'm only looking for things that actually work and have been proven to work over an extensive amount of time through a lot of backtesting and data collection. So here we are. This currently is going to be 8:15 specifically, so we have a little bit of time when we're doing this in a real life example to basically analyze the entire price action. Now, once again, just mentioning it real quick, you don't want to do something like this, only what has internally happened very recently. So we can spot basically our ranges, and first of all, we want to spot our phase. What phase is the market right now? You want to zoom out a little bit. Well, currently we are in an uptrend. Whatever that is going to be for, the higher time frames, doesn't even matter for now. We are in an uptrend. We're making higher highs, higher lows. Okay. Even more recently, what has happened, we have taken out that entire high, broken out of it, but we were not able to basically stay there because the body of this entire candle did not go above this high. This is a very key information in that sense because it tells us the market is showing a weakness right now. Now, this is going to be our range basically, right? We have already identified the phase. We are trending upwards, so preferably we want to take a long. What is going to be our range? Our range is going to be very simple, that high and that low, the most extreme points, nothing complicated about that, okay? Then we want to spot some kind of POY that we have onto the price action. It's going to be that entire FEG in this case, but where do we want to trade into? Is it going to be that high or is it going to be that low? I mean, pause the video if you really need time for it to think about it, but honestly, you can't even know it. Because although I'm saying, look at what has internally happened, zooming out a little bit won't hurt you. I don't want you to do something like this. This is just the point that I'm trying to make, okay? Where you basically see nothing anymore. So we can spot basically that entire thing. And what is even going to be better if we watch it from the 1 hour time frame. We have the 1 hour time frame, and we have one high, another high. These are going to be what? These are going to be our classic relative equal highs. No matter the risk to reward, I'm always going to depend and rely on relative equal highs and lows. From this point on, this already creates a question. Well, probably we could be trading onto the upside, but there's a little bit of a dilemma. Okay, not so fast, because we have this entire FEG, which we have not traded into yet. So the dilemma becomes basically, is the FEG more worth it or holds more weight than the liquidity points? And I can already tell you the liquidity points hold more weight because an FEG happens all of the time and relative equal highs also happen, quite all of the times. But when you're having this clean price action where, we're not taking out these entire highs and we are already in an uptrend. Okay, if we were in a downtrend, then I would be saying, yes, let's trade into the FEG first. But we are already in an uptrend and we have the relative equal highs and they hold more weight than a simple FEG. That's why it's so important identifying the phase firstly before you're going to be identifying your range. Because if you know your range, but you don't know where you're going to trade into, well then, what is that really going to mean? Okay, so the bias is bullish. Let's go into the 1 minute time frame. That's pretty much already enough in terms of the 50 minute. Now, what do we want to see? We want a liquidity rate that has happened on the 1 minute time frame. From there on, we want to see a fractal shift. Okay, let's identify the liquidity points that need to be taken out. It is going to be at the very minimum that low. Even better if we're going to be taking out that low. And the best case is if we're going to take out all of this. Because this, once again, is going to be our, range. Simple as that. This is going to be our range on the 1 minute time frame. Most extreme point, most extreme point. Okay, it's not going to be this one that's already too far away. Because you might as well trade into the FEG and take a short if you believe that this is going to be our external low. Does that make sense to you? I hope it does. From this point on, let's just observe the price action. Okay, we have taken out that low. And by the way, it doesn't even mean that we have to take out these lows. That is just as a reference point what I'm thinking when I'm looking at this. And what are we looking at now? We have basically our first confirmation point in terms of the entry criteria. We've taken out liquidity. The next one is going to be what? We need to see a momentum candle that is comparatively larger than all of the other bullish candles that we had. So let's just see if we're going to get that. Definitely, I would say that this is going to be a candle which is way more than all of the ones that you're seeing in here. Of course, you're going to be having this candle, but this is already too far away. It doesn't matter. So some people would now be saying, well, I would like to take the trade in here, but that's not even needed. Why do you want to take the trade in here? That's when you're going to be taking a stop loss. It looks so obvious because it has already happened. Oh yeah, I would have taken a long in here. No, you wouldn't. You wouldn't. That's why you're going to get stopped out every single time with this. Keep in mind, it's only 1 minute time frame, so you have to be quite fast taking this opportunity. But we are here, we are having time to explain all of the things. At this point on, I am asking myself, okay, am I going to bet on a price action that it's going to just keep that momentum or am I going to bet on the price action that we're going to have a pullback? Now, pullbacks make sense when you're having some kind of other POI that you're looking out for. So let's just say we're looking out for this entire internal pullback. Okay, we are trading higher, but this is going to be the pullback. Well, we have point of interest. Okay, we have all of these FEGs that we're trading towards, and you can take this a step further on the 5-minute time frame. I'm sure there's going to be a larger FEG in here, and so on and so on. But the fact is, you have a point of interest. When you don't have a point of interest, then personally, I just like to take a market order. Okay, the stop loss is going to depend what has previously happened in basically this entire price action. Now, and another thing is also going to be when you're so close onto your range, then you might as well just trade there. Previously, and also in general, when you're having your range, so let's say this is going to be your range, you're having this high, you're having this low, then the question becomes, do we want, so let's just say the bias is bullish, do we want to trade all the way higher, and this is going to be our TP, okay? Or do we just want to target something internally, let's just say this high, or something else that is somewhere in here? And most of the times I'm going to suggest you just take something internally. It's not worth it taking the extreme high. Okay, only if the bias aligns, only if it's a really high probability day. But in this case, since we are just already so close onto it, we might as well take advantage of it. So I'm blatantly just going to be taking the trade. Your stop loss can basically reside at multiple different levels. And a lot of the times you're going to be having something that has previously happened. You're going to be having some kind of low, and this is a lot of the times what I like to do. But in that case, it's a different story because we don't have something internally. But we are also already sure that we're going to be trading higher. Now, in a lot of cases, when you're having your ranges, okay? So let's just say this is going to be our high, this is going to be our low, it's going to be our entire range. A lot of the times it is not worth it trading all the way into the most extreme highs and lows, because you would rather want to, let's just say you're taking the trade in here, take something internally and just be out at the take profit, okay, when you're taking it long. But in this case, it's a little bit of a different story. When you're so close onto your range, then what is the likelihood that you're just going to reverse all the way lower? I mean, we already had our liquidity rates, we already had our pullback. If you're going to wait another time after the A30 time, basically, that's why it's so important also, because these kinds of moves happen only after A30 reliably. They're going to happen also in other times, but in terms of reliability and predictiveness, I like to always look out for A30. From this point on, what I like to do is aim for a 142. Now, but there's a slight problem with this. If we're going to be doing that, then there's also not much room for our entire stop loss. What have we previously looked into on to the 50-minute time frame or also the daily, I mean the 1 hour time frame? We had this entire high, and these are going to be the relative equal highs. So that means that since we're already trading heavily onto the upside and we are in an uptrend in all of the other confirmation points that we have just talked about, it is quite easy to say that we're just going to trade all the way to the relative equal highs instead of just going to continue our entire movement only to that high, and then from here we're going to reverse basically. That is quite unlikely to happen. So that also means that we can increase our stop loss to have a little bit of more breathing room. From this point on, I just like to take the trade as it is. I never like to go to exactly the high. I always give it a couple of ticks of room. From this point on, we're just going to be taking the trade. Now, after this high has been taken out, you're going to be putting your stop loss at break even. That is extremely important. Once again, it has to be something internally. Obviously, these highs have been taken out, but at this moment on time, you were not in a trade. So the nearest high that you're going to be having is this one. Now your stop loss is at break even. It's a risk-free trade. Let's see. But you can also notice that only 2 candles after that, your take profit has been hit anyways. So this is basically how you're going to avoid having all of these unnecessary losses. You see, when you're going to be taking positions like that where the move is just trading higher and you're chasing price, then you're going to see that a lot of the times you're going to get hit at a stop loss. So a classic example would be in here. You're having strong movement onto the upside, you're taking a trade, and then the next thing that happens, it's just going to run into a stop loss, even though technically we have done the same thing like in here. The difference is that first of all, this is before A30. Okay, but let's just say that you're also doing this at A30. You have not been doing all of the different confluences and all of the different steps that we did in order to identify, okay, this time it is going to be the right time when we're going to be trading higher. This is just a big misconception as a whole. Knowing where the price will go is only half of the story. You also need to know when that is going to happen. Well, why? When you're having your most extreme range, so you're going to be having this high, this low. Let's say that I'm 100% sure that we are going to go for that high and we're not going to go for that low. and I'm going to sell my house on that we're going to trade higher. Well, I could be right, but let's just say that I'm going to be taking a trade in here. This is going to be our stop loss. This is going to be our take profit. If I'm wrong on the timing and I get stopped out and only then it runs into a take profit, well, then it was also not really worth much, knowing that we are going to go for that high. So you also need to know when certain stuff is going to happen. And this is always just going to depend on liquidity has been taken out, movement, there's going to be a confirmation, the bias is already bullish, 830. All of these different factors, they play a major role whether or not you're going to hit a take profit or you're just going to get stopped out, only for the trade to run into a take profit anyways. That's the worst feeling ever. So this is going to be our next trade example. Now, as usual, this is going to be at 8:30, 50 minutes before that, you want to do your analysis. What is going to be our phase? And then we want to determine our range. Now, the phase right now, if we're going to look at this, we are trading lower. Yes, we are having this entire low. That is information that we want to look out for. But what we can draw out of this entire price action, we're making lower lows and lower highs. Okay, so the movement is lower. We can also observe we have a couple of different imbalances in here. That is all going to be good for the higher time frame bias, which we're going to look into in just a second. But first of all, we want to identify our range. Very simple. Technically, you don't even need the higher time frame, the 1 hour, the 4 hour with this entire strategy, or this method of basically applying this to the charts to not end up in a stop loss. But it is just always additional information that you like to look out for. So as a question to you, are we going for the high or are we going for the low? Now look at it this way. If we're going to mark out all of these lows, at some point, these were relatively good lows if you're going to see it like that. But they have been taken out. Okay, this was a liquidity rate. This basically would have ended up in a loss if you wanted to trade this higher already. Okay, so now we basically have identified we want to trade onto the downside, preferably that low, but we don't really know if we're going to get all the way lower there. We're having our range. We have already created our 50-50 scenario. Even if we're going to be flipping a coin, we will be half of the times right. Due to confluences, we are way more right than we are wrong in these cases. Now, in the 1 minute time frame, what are we looking out for? We're looking out for internally liquidity being taken out. This can be any high basically. So the very nearest high that I'm seeing is going to be that one. Ideally, I would like to see this one be taken out. And then I want to see strong candle onto the downside. So let's just see if we're going to get that, because you're not going to get that every single day. You're going to be having a trade opportunity every single day, but you're also going to be thinking to yourself, is it really worth it taking a trade if it's not obvious enough? Okay, if it's a little bit harder, then you might as well just skip the day if it's too hard for you. So up until this point, no liquidity rate and no high has been taken out so far. So we're just going to be skipping the entire price action. From here, we've basically taken out that entire high. And this is going to be our liquidity rate. Problem is that it's going to be a little bit too internal, but it's still fine to take. You can now wait for your momentum shift candle, and let's see if we are going to get that or when we are going to get that. So you see we are trading higher, and this is quite interesting because from this point on you're asking yourself, oh man, I'm missing out the trade, let me take a long real quick. No, this is exactly why we are identifying the phase and also the range before we're going to be entering a trade. And it's so damn important that you're going to be sticking to your bias that you have previously identified. The bias is lower, you stick to it no matter what happens. The only sort of invalidation of your bias being wrong, because you also don't want to stick to your or hold on to your bias even though you are proven wrong. The moment when you're proven wrong is basically when you're trading towards that high, to the other extreme point. Once you have done that, well then you were wrong, okay? You will not right on that day. So from this point on, we're still going to be waiting this out. Basically, we're waiting for our momentum candle. What can we see? Is that going to be our momentum candle? Yes or no? Tell it to me. Wait a second. Probably you said yes, but it's not going to be our momentum candle because you have to compare it to what has previously happened. Is this candle this much bigger than, let's just say, this candle or this candle? Not really. So we're going to be basically skipping the entire price action. Now, some of you would now say, this is going to be our momentum candle. Also, no. Why? This entire candle is just as big as this one. It has to be comparatively more extreme than what has happened previously. So still, no momentum candle. We want to wait it out. No momentum candle. So from this point on, the bar has basically lowered a little bit. The threshold of what we consider a momentum candle has lowered. Why? Because the most recent candles have shown us that they are not as strong. So they have gotten basically smaller. So now the threshold of what we consider a momentum candle has basically decreased. So now if we're going to have a candle like this one, now it's going to be a momentum shift candle. It sounds more complicated than it really is. You just have to get the idea that everything is big or small compared to what has previously happened in a price action. Okay, from this point on, we're just going to be waiting this out. Are we going to get a strong candle onto the downside? So far, not really. This is going to be for a lot of you guys a momentum shift candle, but I don't like the wick. I don't trade based off wicks in general, okay? I like to see body closures. So I'm not going to be taking a trade yet. Even though probably at this point you can already take the trade, but I'm not going to be doing that. What can you see in here? I've just called out previously, if you're going to be having this size of a candle like this one, then you're going to be taking the trade, because now comparatively this candle is the biggest one that we have seen in the last 20 candles in this entire thing. Okay, now we're going to be taking a trade. Now what you can do is basically wait out one more candle until you're basically really sure that we're going to be trading higher, but that's not even needed. So let's quickly check what is basically our last liquidity run that we have taken. You see this high has not taken out the previous high. Okay, so we have to put our stop loss higher. When was the last point where we have taken out another high? It was basically in here. And to a lot of you guys, this seems, this is quite of a big stop loss. What are you doing? No, this is professionalism. You don't want to aim for a 0.001 tick stop loss whatsoever. You want to aim for something that is realistic. You want to give the trade room to breathe, or else you're just going to get stopped out once again. Now, I've previously told you don't want to trade into the extreme points. This is going to be the same case for here. You don't want to trade all the way lower into that one. What I would rather like to do is just go for that low. Okay, some of you might be saying, well, if you're already trading to that low, is it worth it to extend it lower? Perhaps, but I just like to always focus on my win rate basically, because I believe that the win rate is more important. They go hand in hand, you get the correlation, but it's just what I like to trade based off from. Now, our break-even confirmation, what is it going to be? And I love this example as a whole, because previously we had a low basically that price has broken. Now we're going to be putting our stop loss at break-even. Here we don't really have that. The closest nearby low is going to be this one, or this one in that sense, right? This is also the reason why this take profit is here, because it's the only logical thing to put the take profit into. In this case, we're just going to go by our 1-for-1 rule. Once we have basically traded 1-for-1 into our entire risk reward, we're going to putting the stop loss at break even. So right now, stop loss at break even, risk-free trade, and you're just going to let it run. Let's see. And a couple of candles after, we have hit a take profit. That's pretty much it. Okay, this is the exact way how you're going to be avoiding always hitting a stop loss. And it is just a confirmation of, let me rewind it real quick. It's going to be, find your phase. What phase are we in right now? Uptrend, downtrend? Do we want to take a long or short today? What is more likely that we're going to be trading towards? The high or the low of that range? Once you have identified that, it's going to be the low in that case. You drop down onto the 1 minute time frame and you want to see candles being taken out. If we're taking a short, then you want a high to be taken out. If you want to take a long, then you want a swing low to be taken out. And from this point on, you always want to stick to your bias. This is the very last lesson in that sense. Stick to your damn bias. Even though you're trading higher, don't get scared out of the price action. Stick to the bias, and from this point on, this is pretty much a very easy strategy. Now, I've gone in an extensive amount of detail in this entire video about my strategy. But if you want a way more simpler approach, where you don't have to look out for the higher time frame and whatsoever, where you really just want to have it written out, okay, range here, take a trade here, entry here, stop loss there, take profit there. Then click on this video. It's going to explain to you even more simple how I'm operating on a day-to-day basis. On my second channel, I have actually collected a bunch of different live trades at this point, and you can clearly see that I'm not doing all of the different analysis. This is just what's going on in my head when I'm basically taking the trades live. But if you want to take a more simple approach, then I recommend to click on the video. And remember guys, always trade based off data and not guesses.